Hi, my name is Sid from KOSEC Kodari Securities, and today I will be going through the Average True Range Indicator, or ATR. This is a technical indicator we implement here at KOSEC, and what a lot of professional investors use as a guide to better time entry and exits and spot potential breakouts. Now, as always, all information given is general in nature and doesn't take into account your personal needs or objectives. For further information, please do visit our website, www.kosec.com.au. Here's an overview of what we will be going through today. First off, we'll start with what is the ATR, or Average True Range Indicator, go through how it works, how to read it, see an example on how to read it in a chart. It's fairly simple. And then we'll go into a couple ways that it can be used, and we'll see a couple examples of that. Now let's go through what the ATR indicator actually is. Now, the average true range indicator was first introduced by J. Wallace Wilder Jr. in his book titled New Concepts in Technical Trading Systems. You may actually find this name familiar as you've actually heard it in one of our previous presentations before, because J. Wallace Wilder Jr. was the same person who came up with the relative strength index concept. Now, the ATR is a technical indicator that measures market volatility. So, in layman's terms, it shows how much an asset moves on average during a given time frame. Now, moving on to how the ATR actually works, or how it's actually calculated. So, given here is the formula behind the ATR. Now, to calculate the ATR, first the true range needs to be discovered. The true range takes into account the most current period high-low range, as well as the previous period close if necessary. Then the true range is said to be the largest of the three calculations shown here. So the first one is the current high minus the current low. The second one is the absolute value of the current high minus the previous close. And the third one is the absolute value of the current low minus the previous close. And then once you have all those three, you take the greatest value of that. Now, absolute values are used since the ATR actually doesn't measure price direction, only volatility. So keep that in mind, it's very important. Now, once the true range is actually calculated, then the ATR is plotted as the moving average of the true range. Now, it can be exponential moving average, running moving average, regular moving average, that you can actually set that in the technical charting tool that you use. So here's an example of how the ATR will be displayed on a technical charting tool, which is, at the bottom here. Now, as you can see, it's very simple to read. Just basically, an increasing ATR represents an increase in volatility. Now, as I mentioned previously, the ATR shows how much an asset moves on average in a given time frame. Another way to notice this is actually by looking on the chart and observing the body size of these candlesticks. Now, as you can see over here, the ATR is increasing at a very steep rate. And if you see here, you can see these bodies of the candlesticks, say compared to anywhere here or anywhere here. It is a lot larger, especially say, for example, this one, this one, this one. It is a lot larger than these other candlesticks over here, the average size of them. Now, obviously, the time frame on this ATR is defaulted to 14 days, which is what a lot of charting tools will do. A lot of charting tools will default to 14, 20, or 22 days to keep it within the realm of a month. So that's a default setting, but you can always change that based on your trading style. Now, moving on to a couple ways that the ATR can actually be used. Now, obviously, ATR once again doesn't measure price direction, only volatility, as you saw in the previous example. At the end there, when you saw the candlesticks getting bigger and the price action dropping, you would have noticed that the ATR is actually moving in the opposite direction. So once again, this point, I just wanted to reinforce that. Now, the way a lot of people use ATR is they actually use it in combination with other indicators to find potential explosive movements. Now, for example, you can use it in such a way where if the price action breaks a level of support or resistance, and if you combine it with the ATR and you see an increasing volatility, then that tends to validate the movement. And additionally, you can also use it to identify periods of low volatility on a multi-year time frame to pinpoint potential breaks out. And we will go through a couple examples in each scenario. Now let's look at a way that you could use the ATR to help guide you to spot potential reversals in trend. Now I have plotted the ATR down here. It's a 14 period ATR, one of the default settings, and I've used the exponential moving average of the true range to calculate the ATR value. Now I've also plotted the moving average or the exponential moving average, 200-day moving average to keep things consistent. And we've also got a trend line here. As you can see, this is National Australia Bank, ASX code NAB. And you can see that overall, it's been in an upward trend since around that December or the end of 2018, start of 2019 period. Overall upward trend. Now, the first point that I wanted to focus on was this purple line right here. Now, as you can see, up until then, increasing ATR. So as I mentioned in the previous slide, an increasing ATR tends to validate movements in or sharp movements, upwards or downwards. Now in this case, it's actually broken that bottom trend line and it's moved downwards. So potentially something to keep an eye out for at this stage, because not only has it broken that trend line, which would be your first indicator, but then you could see an increase in volatility. Now, the next day, you can see that it's kind of bounced off that 200-day moving average and it's been bought back up a bit, which is, it's a good sign, but you still want to keep an eye on it. And then you can also see that the ATR went back down. But then the next 2 days after that, you can see that not only has it broken its 200-day moving average, but the volatility has also increased right there and come back up. So that would potentially be your sell confirmation to get out, because I mean, obviously if you've held it, you would have been or down all the way. You would have been in the stock for this ride down here. So that could potentially be a way, that you could use ATR as a guide. I've only used it with one other technical indicator here, which is the moving average. But combining it with other indicators such as Donchian channel, stochastic oscillator could potentially give you a better picture. Now I'll go through another way you can use the ATR to help guide you to spot potential breakouts. Now, one thing to note is that stocks or markets always go from in cycles. So they trade in cycles. They'll go from a period of high volatility back down to low volatility and back up to high volatility. Now, as I mentioned in a previous slide, you can use the ATR to identify periods of low volatility on a multi-year time frame to help you pinpoint potential breakouts. Now, in this example, we'll be looking at Brambles Limited, ASX code BXB. Now, looking at this, there's one area, or well, actually two areas of multi-year low volatility you will be able to see, which is one area is around here, and the other one will be around here. Now, let's look at the first area, or the one in around 2013. What price action or what area that corresponds with? If you take it here, say for example in that middle area, that line corresponds with around here. Now, as you can see at this point, not only has it broken above that 200-day exponential moving average, which is this blue line here, but it's also at a period of historic low volatility. So that could potentially be an entry point that you could have gotten into. And as you can see, if you did, then you'd have been exposed to this huge upward trend here. Now, obviously, if you missed that point, there is another point where it does get to around that same level of low volatility, which is around here. So that corresponds with anywhere around this point, or around this general area. And if you had gotten in there as well, not only once again has it been trading above that 200-day moving average, but once again, if you had gotten in here, continue that upward trend, obviously with swings here and there, but using other indicators, you could have potentially other indicators like the stochastic or MACD, you could have potentially gotten out here and bought back in here. But once again, using the ATR and something else like as simple as the moving average, you could have potentially identified this entry point right here. So this is another way that you could use the ATR to help guide you spot potential breakouts. So in this presentation, we took a look at the ATR and how it works. We went through a few ways on how to use it and looked at an example. Hope you have found this video helpful. It has been brought to you by KOSEC, Kodari Securities. Thank you and have a nice day.